Hi, folks. This is Craig with 3D Consulting coming to you from my basement in the Seattle area. Thanks for watching today. And this module is Module 6A, Cannabis Retail Fundamentals. And this is with respect to I-502 operations in the state of Washington. And of course, much of it applies to any state where you might be licensed to retail cannabis legally. Okay, so today in the fundamentals, I'm going to talk about 5 things. The first thing is 10 costly mistakes to avoid. Second thing is 3 simple tools that every cannabis business needs to survive and thrive. The third is 6 key performance indicators or KPIs for cannabis retail. The fourth thing is the basics of retail finance and accounting. And the fifth thing today is positioning your store in a competitive environment. And we all know that competition is very strong, or I should say it's very prevalent. It might not be strong. You might be a great competitor in a neighborhood of people who are falling all over themselves. So the competition might not be strong, but it's definitely everywhere. All right, so let's start with the 10 costly mistakes to avoid. The first one is don't buy from your friends. And I should temper that a little bit by saying, because your friends might have a great product, might have a value price that makes sense for you and your customers. That's all great. If you're buying from your friends just because they're your friends or just because they are a celebrity grower, that is not, because you like them is not necessarily, that's not a business fundamental. That is, it's show business. It's not show friends. So you want to make sure that your decisions are based on the value for you and your customers and make sense for the business's bottom line. The second thing is don't allow inventory intake through the front door of your retail showroom, okay, your retail floor. Early on in 502, right after legalization, many stores that I visited and many that I delivered to early on, I had to carry bins full of cannabis product in the front door through, kind of weaving through fixtures and customers who were mulling around back to a back room. And it's, that is not a good look in retail. You want to be able to have somebody come around the side, come around the back, so that your inventory operation is separate from your retail operation. Everything that happens on your retail floor should be geared toward the customer. And in a lot of cases, when I was doing that early on, I would walk in with full bins. People would see me, retail customers would see me, and then I would walk out with empty bins, and maybe in those empty bins, in a lot of cases, there was $20,000 in cash. And I was walking out through people holding $20,000 in cash in a bag, a shoebox. One time it was in a U-Haul box or in the bins, which were transparent. So for a lot of reasons, you want to avoid having doing inventory intake through the front door of your retail store. The third thing, don't discount everything every day. Use your discounts wisely and strategically to build relationships with customers who are not transient, who are coming in all the time. A lot of money is lost or given away by stores who, let's say, give everybody who comes in and gives their name and phone number for to have an account in the store, give them 20% up front. That's the first time they sign up. That is I like that model. The problem is a lot of people try to take advantage of that by coming in and giving a new phone number and starting a new account and getting 20% every time they come in. Or tourists might come in just one time and get that. Okay, so if there are ways that you can use and strategies that you can use to communicate and avoid giving away discounts that don't benefit the store in the end. The fourth thing is have effective signage. Don't have flat, dark, just green and black signage. Okay, signage that pops is so important in our business in particular. The fifth thing is don't hide any parties of interest or any financiers. There's a lot of things that have been tried in the past that I've seen that I would never recommend, but folks tend to, hey, if the store owner has a friend who has a credit card with some runway on it, some free balance on it, then they've tried to do that without reporting this new finance as a true party of interest. Hey, it's just on a credit card. It's just a fixture that's going into the store. That's how you start to get in trouble. Okay, compliance is it's always hard to be 100% compliant, but it's a good goal to have, and you should understand how to be fully compliant. The sixth thing is don't spend any money that is not run through the business. In other words, side deals where you purchase things on behalf of the business, and then it becomes kind of kludgy or cloudy where the money came from or how a fixture was paid for. If you are a true party of interest on the license and you are going to fund the purchase of something, put the money in the business and spend the money out of the business. Do not go around and purchase things from vendors to then put into the store, and there's no record in the store's finances of how that spending was done. Okay. Never operate without operating agreements with your partners. Your operating agreements need to say how the membership of the investment group of your store, how they operate, who is in charge, who can do certain things, who is an administrator. Okay. And what happens if the store needs cash? How is that cash call made, and how is cash collected? All these things, if you don't have an operating agreement with your partners, you're going to have trouble every time something new happens in the store. The eighth thing, don't carry every available SKU. So don't carry every product. Having a huge variety of products can be very daunting for customers. Having a curated set of products can be more efficient. You're working with fewer vendors. You're curating your merchandise according to who your clientele is, and that's so important. You're not selling anything to anybody who has money. You are selling curated product lines to clients who you serve, you listen to, you have a relationship with. The ninth thing, not everybody can or should be the Walmart of weed. It kind of goes along with what I was just saying about don't carry every SKU. The Walmart of weed, that idea is basically, we're going to have the lowest price. We're going to compete on price. Nobody's going to underprice us. We will never lose on price. Well, what you'll find in that case is you will attract a certain type of customer who ends up coming in for those $1 joint days, and they will pull out 4 quarters and pay you $1. And that is not the type of customer that you're looking for. You are not Walmart. Um, this is a service business, and these are small stores, small footprint stores, where it's high touch that wins. Okay. And lastly, the 10th thing is there are only so many seats on the bus, okay, in your staff. So you don't want to employ too many people. You want to be stringent and focused and strategic about who is on your team, and the folks who are on your retail team should be high contributors. And as they say, there's only so many seats on the bus, there's only so many spots in your payroll. And so don't fill them with folks who are not contributing. All right, so those are the 10 costly mistakes to avoid. The second thing, the 3 simple tools every cannabis business needs to survive and thrive. Number 1 is a robust point of sale system. And that point of sale system gives you so much data, more data than you could ever really use. But using it smartly is how you will succeed in this business. It's tough, the days of just having a good location and having, a high quantity of door swings. Those, that does not make for success anymore. You need so much more than that. You need to be strategic, and you need to learn from the data. And when you pull a lever in your business and you decide, okay, I'm going to increase the price of this, or I'm going to shift my merchandising mix to carry more high-end, high margin infused pre-rolls, let's say, you need to be able to read your data that will tell you, did that, I increased the price. I'm guessing that I would see a slight reduction in the volume of sales in infused pre-rolls, but is that, is the total margin dollars, meaning the total number of units times the margin that I'm making on each unit, did that go up with the change that I made when I pulled that lever? And if you have a good point of sale system and you understand how to read the data, then you're in a winning position, and you can make strategic choices about your business, data-driven choices. The second simple tool that every cannabis business needs is a business plan. This is a numeric, a custom model for your business that shows how your business makes money. And that would be, each day, each week, each month, we have this much average revenue. We have seen this average percent of gross margin. And then we have these expenses. We staff to this level. So it's kind of a budget. It is a projection going forward. It's a narrative and a translation of your strategy into dollars and cents. Okay, that is a business plan. The third simple tool that every cannabis business needs is a cash forecast. I think that probably 90% of stores, and really small businesses of any kind, don't have a cash forecast. That's what I've seen in my own travels. And it's a shame, because the only way to run a business without a cash forecast is just keep pedaling that bike so fast, so hard, that you feel confident that your bank balance will never go to zero. Okay, you're kind of running to stay ahead of that zero, and you don't know what will happen or what day you might have a cash crunch. And it's a tough position to be in. And if you just do some, basic math and look out over the next 3 months and think about, okay, who am I going to be paying every month? Where am I going to be getting money from every month? How much is that? Um, that's the kind of simple planning that will keep you ahead of your goals and let you sleep better at night. So those are the 3 simple tools every cannabis business needs. All right, the third thing today, the 6 key performance indicators for cannabis retail. They come in 3 categories: growth, revenue, and profitability. And there are 2 key performance indicators for each of those 3 categories that I like to use. You can use slight variations on that. There might be some things that you like to look at that are more important and to you. And there are, as far as key performance indicators, there could be 100. Key performance indicators, you want to keep it as simple and as impactful as possible. Okay, you can't manage 100 different performance indicators you can't manage them all to improvement, because many of them will be opposite sides of the coin from each other, or they, conflicting in some way. And so really what you need to focus on are the things that always move your business. So for growth, the 2 that I like the most are door swings and advertising ROI. And those 2 things, door swings, obviously we want to see a trend that increases. And so every time that you make a change to your strategy or your advertising, you would expect, what you want obviously is an increase in door swings or an increase in the basket size. But that's something that I've got in revenue KPIs. So let's talk about door swings. And really, I think in most point of sale systems, the door swings are called baskets, number of baskets or number of ring ups. Okay. So you want to be doing things to drive more traffic, drive more door swings. And then advertising ROI is, if you make a change in your advertising and it increases the number of door swings that you have, and you make, let's say that you make something like, $10 of profit every time somebody walks in the door. We're talking gross profit. If you make $10 of gross profit every time somebody walks in the door, then if you're able to get 1 person more per day for a month based on a change in advertising, or 5 more people a day, your trend of traffic took a step up once you started this advertising. You're getting 5 more people a day. That is 5 times $10 more that you're getting per day. $50 a day, $1,500 a month. So it's not small. $1,500 a month is a good return depending on what kind of advertising. If that advertising cost you $3,000 a month, your ROI is still in the red. Okay, but you need to be looking at how you can get that into the black, how you can get the impacts of your advertising to exceed the cost of doing that advertising. That's your return on that investment. All right, so for the category of revenue, I've got average basket size and merchandising mix. Average basket is obviously the size, what's the amount of money that your average ring up is. And in many stores, it tends to be around $35 to $40. In some locales, it might be as low as $28 to $30, and in some, $40 to $45. But it tends to be around $35 for the industry. And there are ways to increase that basket. That might be things that let's say that you have every bud tender say at every sale, hey, do you want these, special joints with that? Or, just like McDonald's used to say, they might even still say it, do you want fries with that? So that is a retail tactic that drives extra sales at the point of sale. Let's get that average basket up. The merchandising mix. This is, how much, what percent um, of your sales are part of your most profitable um, merchandising category. So let's say that your most profitable merchandising category on a margin basis is vape carts. All right. And you want to increase overall margin in the store. One way to do that is to increase the number of vape carts that you sell. And so that is something that a key performance indicator that you can look at in the revenue category. All right, so profitability is the third category of KPIs. And the two KPIs that I like in that category are gross margin, and that's a percent, of course, and inventory turnover. So gross margin percent, this is your net sales minus your cost of goods of that sale as a percent. So if your average sale is $36 and your cost of goods sold on $36 is $20, or let's say $24, the numbers are easier. $24, that's, that COGS rate is 67%. Your gross margin percent is 33%. You made $12 on a $36 sale on average. And so your gross margin is $12, and you've got to figure out a way to increase that. It might be less discounting. It might be, like I said, shifting the sales strategy to selling more high margin mix and selling fewer of the lower margin products. That's how you increase profitability and gross margin. Inventory turnover, how quickly are you going through inventory, and how tightly are you managing that so you don't have a lot of obsolete inventory that should be clearanced or marked down back in the warehouse. All right, so your inventory turnover, how quickly and point of sale systems have this data as well. How quickly are you selling the inventory that you're taking in? All right, the fourth topic today, the basics of retail financing and accounting. I want to talk quickly about markup, discounting, cost of goods, operational expense, and capital as an expense. So number one, markup. Retail markups tend to be, and they are in Washington 502, it's generally a 3 times markup maybe at the minimum, which includes taxes. But really, it's a 2-time markup. It's a keystone markup where it's really about 100% of the wholesale price. So if you bought something for $10, you mark it up to $20. That is 100% markup. And then the profit margin on that is you are profiting $10 out of the $20 sale that you made. So your profit margin on that is 50%. So that's the difference between a markup and a profit margin. Okay. The second thing in the basics of retail finance and accounting is discounting. Like I said before, you want to do this very strategically. You don't want to discount everything. And discounting, you want to make sure that when you do discount, you are able to increase the volume enough that the lower margin you're making on these products that you're selling times the increased volume is greater than the margin dollars that you were making before any effort at discounting. So the worst thing that you can do is have a stable amount of volume, sales volume, add on a discount, and have the same amount of sales volume. Now you're just receiving less dollars in profit You want to be going the other way. You want to be doing the type of strategic discounting that drives more volume so that you can make it up on volume, as the saying goes. Okay, the third basic is cost of goods sold. And I think we all know as what cost of goods sold is in this industry and in retailing. It's obviously the wholesale cost of the goods that you sold in that transaction. It also is a percentage of the work that some folks like the inventory purchasing and management folks and some other folks in the store that contribute to the cost of purchasing these goods. That also goes into COGS, because we want COGS in this industry to be as big as possible, because you are taxed at your gross margin rate, which is the only thing adjusted off of your taxable base of income is the cost of goods sold. So the bigger the cost of goods sold is, the smaller your tax burden is. The fourth thing is operational expense. It's not COGS. It includes wages, advertising, rent, supplies, insurance, these things that are not variable based on sales. These are more fixed costs, and they are not deductible in regular, more conventional businesses and industries. That all is deductible for taxes, but in the case of cannabis, it's not. So you need to be very diligent about your operational expense. Okay, nothing extra. Your expenses need to be very tight, and you need to justify those operating expenses at all times. The last thing is capital expenses. The biggest capital expenses that happen in retail tend to be tenant improvements to the building that you're in, and things like fixtures and furniture for your store. So these things, and computer systems and security systems as well. These things tend to cost more than $1,000 and last more than a year. And when you purchase something large, let's say it's a $20,000 point of sale system, when you purchase that, that should not come off of your income statement as one expense in 1 month. Okay, that will submarine your profitability outlook for a month. And that's really not what's happening. It might submarine your cash because it's all cash out right now, but really that point of sale system is going to support your business for, let's say, 4 years. And so 20,000 over 4 years, you want to spread the cost in your income statement in a section called depreciation. You want to spread that $20,000 of cost across 4 years evenly. Okay, that is the difference between a capital expense and an operating expense that we talked about just now, where this is money leaving your business every month. And that is, just kind of as your business runs, that's the exhaust going out the back. Okay. The last thing today is positioning your store in a competitive environment. So a few things about clientele, your store look and feel, pricing philosophy, your merchandising mix, and you being easy to do business with. Those are 5 things about your positioning. And the first thing, clientele, is really interesting because, I support a store right now that has 2 locations in 2 very different parts of town. And one is very industrial, one is very residential. And the mix of sales and what we have to buy for those stores differs significantly because the clientele is different. And so start with the customer in mind and work backwards to what you can provide them. Don't think about it the other way, which is what I like, and I'm going to have all my stores be the same, and I'm going to put out the same mix of merchandise in each store, and people will just have to buy it because that's how I operate. I'm being efficient, and that's not it. You need to start from the client and work backwards to your business.